Great. Thank you, David, for your kind words of introduction. I'm Rob West. By way of an introduction, for those of you who don't know Bernstein, I'm an equity analyst at Sanford Bernstein, which is a Wall Street equity research firm. And I'm based in Europe, part of a team that covers 16 stocks, primarily the European integrated E&Ps and Russians. And crucial to understanding these companies and the outlook for their production, for the production of the assets that they run, and also for oil supply and demand is decline rates. As David is saying, how fast will today's existing stock of fields run down and stop producing, and when will the rocks win, how soon will the rocks win, and what can you do about it? How can you slow that down? And so today this is a real challenge, because you see that conventional oil supply, especially offshore, is declining. And we have done about 80% of a book that we're writing on the team, my boss and I, on the drivers of decline rates in these mature hydrocarbon basins. And it's a very data-intensive piece of work. We've gone through about 80,000 wells, just going through everything we can get our hands on pretty much the entire history of the UK, Norway, Russia, Brazil, the Gulf of Mexico, field by field, well by well, looking through everything to try and see what are the patterns here, how can we get ahead of the curve in understanding what's going to happen to these fields. And so let's look at the declines, and this is going to be very depressing because all of the world's nice oil provinces are running out. Here we are in Norway, and you can see on the left-hand side of this chart that at peak in 2000, Norway was producing about 3.5 million barrels a day of oil. And I've plotted the fields on this map so you can see where they are. The size of the circle here is proportional to how much oil the fields are producing, and the color of the circle shows how recently they started up. So you can see these nice big blue circles, which is very large, very new, very recently developed fields. And you can see the particularly large Ekofisk field in the south, which is producing about 350,000 barrels a day, and Statfjord, the 700,000 barrel a day monster up in the north, all looking pretty prolific. And then you fast forward to 2011, and the picture is just vastly changed. You've got much smaller fields, much more mature fields, and I think it's particularly striking up in the Norwegian Sea at the very top, in the very northern part of this map. These fields that were very large a decade ago are a fraction of their size today. And not only is this important in terms of the size of fields that are producing, but it actually changes the whole look of the industry. So if you go back to the early 2000s or the 90s, about 10% of Norway's oil is coming from what you could call small and medium-sized fields, i.e. those that are producing less than 50, 60,000 barrels a day. And practically nothing, a negligible amount, is coming from fields that are producing below 10,000 barrels a day, things you would regard as really small fields. And then if you fast forward to 2010, 2011, half of Norway's oil is coming from small and medium-sized fields, and a meaningful 10% is coming from tiny fields of less than 10,000 barrels a day. And as we'll come on to talk about, it would be great if Norway could achieve a 60% recovery factor across the board. We're a bit cautious on whether the economics of that work, so we'll get there and we'll talk about that a bit later. You get exactly the same picture in these other basins that we've analysed. So the North Sea, again, if you look in 1995, roughly when this basin peaks at 2 million barrels a day, healthy constellation of big blue circles, and then push forward to 2011, it's just depressing. These tiny, very, very old fields. Some respite from the decline of the central Graben, however, you can see is evident in bringing on new fields in different places. So in 2011, on the right-hand side of this chart up here, you can see you have these blue circles, which are the new fields, and they're coming on. There's Buzzard, and here's fields up in the Shetlands like Schiehallion, Finhaven, and even in the Celtic Sea, and maybe one day we'll be off here for British oil supply. So same picture in the Gulf of Mexico. You can take that. I have to say, having looked through all of these different government releases on well data and field data, the BOEM data is just, you can lose days kind of looking at it, trying to figure out what's going on. But this is every well drilled or in production in the Gulf of Mexico, shown in 2001 and in 2012. And actually, it's interesting that this is not a basin that's in decline overall. So we had about 1.7 million barrels a day of production here in March 2010, before the worst thing ever happened. But that's a peak of production in this basin, and moreover, the biggest influence of declines on a kind of intra-yearly basis in these fields isn't necessarily declines at the fields themselves, but the month of September, which is the one that's most prone to hurricanes, and you actually, on average, have about 300,000 barrels a day less production in the Gulf of Mexico in September's, because hurricanes sweep through and take all the wells out of production. But just as in the North Sea, you can see that even though the basin as a whole hasn't declined here, the patterns of where people are producing the oil from have changed. So look back in 2001, you had this really healthy cluster of wells kind of all along the Gulf Coast, and by 2011, look, that's just completely cleared up. And again, the deep water in 2001 stops right at the edge of this kind of particularly shallow bit of the deep water, and now look, we're going into just the very deepest parts of the overall basin. So again, big change. And you're probably getting bored of slides like this, so this will be the last one, but it's Russia, and you can go back not just 20 years or 30 years. With Russia, you can go back to the first production in the 1860s in Baku, and I have to say the quality of data back then is not particularly good, but what you can find is the same pattern. So you've got this this Volga-Urals region, which is particularly strong in 1985, up at the time of Soviet peak production. They're producing 12.5 million barrels a day. West Siberia is very, very new, very recently developed, all these healthy blue fields. And then today, look at this, Volga-Urals is greatly declined, all these mature fields. Likewise, the hub of Western Siberia is mature, and you're going into new areas. So you've got Vankor in East Siberia and the Timan-Pechora region up here, and again, one day hopefully Rosneft will have something around there. There's the whistle-stop tour of declines and changes in production at these basins we've looked at. Why does this matter? Why is it so important? Well, I guess it's not just because we've looked through 80,000 wells at 3,000 fields that produce 17 million barrels a day, and now we have to retro-justify it. But the real reason is because where I sit, we talk to companies all day, and they say, yeah, you can just expect our mature fields to decline at 5% a year. And you think, okay, so probably there are people out there in their models buying these stocks or recommending other people to buy the stocks who are just kind of taking that guidance at face value and saying, yeah, let's run down the existing production base at 5% a year. But I mean, if you're talking about a Gulf of Mexico oil field and you're assuming a 5% decline rate, you've got a disaster in your model, and your valuation is, it's not off, it's wrong. The key to really getting behind how these fields are going to perform in the future is to understand how they're going to decline over time, and which ones are going to decline more and what you can do about it. So that's the challenge and the prize for enhanced oil recovery. So after going through all of this information, what do we find? Well, as I said before, rather than just a flat 5% decline rate assumption or a flat 10% decline rate assumption, as we know some people out there use, you get very different numbers when you look across the different oil-producing regions globally. So let's start, say, in the UK, and let's start with the green bars on this chart. So this is, if you just take the entire history of the entire basin and look at the median decline rate at fields that have been developed there, you're talking about, say, 9 to 12% in the UK and Norway. You're talking about 9% in Brazil, so much lower, so Great Basin. You're talking about a really high decline rate in the Gulf of Mexico, linked to the geology. We'll talk about that a bit later. But 22% is what you can expect a field in the Gulf of Mexico to decline at on average. And then the last one on this chart is Russia, which has incredibly low decline rates, and that just reflects the fact that onshore oil production is chalk and cheese when compared to what you've got offshore. Just completely different, and we'll see that later as well. The blue bars here are showing an attempt to understand what is the typical decline rate at a well in these basins. And you can use some fancy statistics, but effectively what you're doing is you're stripping out the fields where you have new wells drilled, and you're just looking at the declining fields, and from that you can isolate or estimate the decline rates at individual wells on average. And the patterns are broadly similar. Again, it just reveals that geology is what's driving this. Different basins decline faster or slower. What's interesting, I think, on this chart, though, is to compare the greens with the blues. So remember, the blues is what the wells naturally decline at. The greens are what the fields decline at. And so the difference it follows is how you manage the fields. So look at the biggest gap between the greens and the blues in proportional terms. As you might expect, it's Norway. It's the country that has the reputation in the industry for focusing more on enhanced oil recovery and very high recovery factors than anywhere else. And that's good for them up to this point. But as I'm going to say later, let's see how much further they can go with these EOR programs. I like the caption that sometimes the rocks win, because you really see the impact of geology when trying to compare what's driving the decline rates at the different basins. So this is just an example in the Gulf of Mexico. You can take all the wells, you can aggregate them by whether they're carbonates, whether they're sandstones, whether they have different type of drive mechanism, porosity, permeability, see what's actually driving the decline rates here. And this kind of informs just what everybody in this audience probably knows about why fields decline, right? The first reason is that eventually, as the wells get older and the fields get older, the pressure at the bottom of the fields gets lower. And so what you see here in the Gulf of Mexico is that for fields that have a combination drive, so water pushing up on the oil from below and gas pushing down on the oil from above, the decline rate is actually lower than fields that don't have this water support or don't have gas support right on the other side of the chart. And so, this is key to us, because a company comes out and says we've discovered a field and it's got great pressure support from a combination drive mechanism, and immediately that's going to be more valuable than a company that says this is a field which has low pressure and we're going to struggle to get the oil out of the ground. But it's not just declining pressure at the bottom of the well that can cause your fields to start producing less. The other interesting drive you find is, sometimes the wells are producing exactly the same amount of fluid, but it's just the wrong stuff that's coming out, right? So here's the water cut of different fields over the last 10 years in Western Siberia. And the orange dots here are showing you the production a long time ago in 2000, and the blue dots are showing you production today. And the general trend is that as the water cut increases, the productivity per well declines, right? And it's kind of hard to see it maybe on the chart, but the general trend is to move from top left to bottom right as the fields get older. So all the orange dots are down here and all the blue dots are up there. And so, this is also particularly important when you see wells that start to water out. And there are companies out there that we look at where they have assets, say, that have been in production for 24 months, and already they're taking wells offline that are turning to water, and that's really negative. And we're going to be worried about that kind of thing. Third driver of the decline rate, it's the rocks, right? So you can go through, this is the North Sea as an example, all of the different fields classified by whether they're sandstone reservoirs or carbonates. And again, you find an interesting pattern, which is that, look, on average, the carbonate wells decline faster than the sandstone ones. And I think the best way to explain this is just in terms of how the production is flowing through these reservoir rocks. So think of a sandstone; it's a matrix of interconnected porosity, and the oil migrates through the reservoir, and it's produced from this this coherent spongy rock of oil. And the carbonates, other than say some of the maybe the Ekofisk in Norway, this is a very low porosity, low permeability rock, and what allows the oil to flow is the fact that you've got a really highly fractured reservoir, and the oil is being forced through those cracks, and so you tend to get faster flowing wells initially, because this big network of cracks effectively acts as a very, very large surface for the oil to run through, but then it declines faster because it's coming from such a distant area. And so the conclusion here is you can't really escape the geology. You're pretty much stuck with it. And one of the reasons we think this is going back to a point I was making earlier. When you compare the changes in production at the Norwegian fields and the UK fields, and the changes in production at the UK wells and the Norwegian wells. Do you remember I was saying that Norway, very high recovery factor, huge investment in EOR, and they've actually achieved a lower decline rate at the field level. But what's interesting is when you plot the individual wells on a curve and you say, what do the best quartile wells do? What does the average well do? What does the worst quartile well do? The UK and Norway are just remarkably similar. So, the average across all UK wells is 21.7% decline rate, and the mean average across all Norwegian wells is 21.7 mean decline rate. And because the fields are better managed, i.e. they drill more wells, they do more in terms of injection and other things that I guess other people today will talk about. The fields decline slower, but if you look at the underlying wells, they're almost exactly the same. It's kind of remarkable. So you can run from the geology, but you can't hide. And you see evidence of this in the production levels from each field over time. So this is one of my favourite charts to come out of this piece of analysis. It's showing you the number of wells. Well, actually, okay, let's back up. It's showing you the 25 largest fields in all of the basins that we've analysed. So all of them you can see here. The 25 largest fields, pretty much most of them produce between 10,000 barrels a day and 120,000 barrels a day. But what's really interesting within this picture is the number of wells you need in the different basins to get to those production levels from the different fields. So if you look at Norway, great correlation. Basically, the number of wells that you drill is going to be proportional to the amount of production that you're getting out of the fields, and vice versa. If you look in the Gulf of Mexico, you get a very similar picture. The scatter is less good. You've got a bit more variation in what's going on, but you have some of the fields up here look really productive relative to the number of wells that you have to drill to get them developed. And then you look at Russia as an example. This is what I was saying before about this being just a completely different game of oil production. You have to have 1,000 wells on average to get a Russian field into this top 25 range with production levels that compare to these offshore provinces. And when you're thinking about the costs, I mean, it helps that a Russian well today is going to cost anywhere between $3 million and $10 million, depending on how you complete it and what you do with it. But you couldn't be drilling these $20 to $100 million wells in Russia and make any money at all, because you have to drill an order of magnitude more of them. And then the final country to mention on here is the Red Crosses, which are Brazil. Wait, is this the next thing I talk about? No, I'll talk about it later. Just you can see they're a phenomenally good resource in the sense that you have to drill many fewer wells to get the same amount of oil out of the ground, and that shows up in the economics. In fact, the next set of slides is really focusing on what does all of this mean for the economics, and it's actually really important. So the first reason for that is that the geology here that guides these decline rates shows how fast the fields will ramp up and how fast they'll decline. And so you can see in the highest decline rate basin, which is the Gulf of Mexico, the fields are producing very low portions of their peak production by the time they get a decade into their lives. In fact, by about 15 years, you're lucky to be producing anything at all. In the UK, slightly better. In Norway, slightly better still. The onshore production profiles in Russia, aggregating all of this data, is completely different. I mean, look, here you're peaking after 1 to 2 years. In Russia, it takes about a decade for a field to ramp up to full production, and then it declines very slowly. This might seem puzzling, but actually the peakier production profiles are more valuable to the industry, because the way you look at it from an NPV perspective, I'm sure you know this, but a dollar today is more valuable than a dollar tomorrow and more valuable than a dollar in 10 years' time. So if you take these Gulf of Mexico fields, for example, you're extracting 95% of the oil from, say, an N million barrel field within the first decade. And so you're extracting it sooner, so it's more valuable for a same size discovery. And likewise in the UK and Norway, you're faster, but you're still slower than the Gulf of Mexico. And in Russia, look at this. I mean, to get to just half of the oil out of the ground, it takes 20 years. So it's much less valuable today. And you can quantify that in terms of MPV. So what you see is that on the bottom here, this is the Gulf of Mexico compared with, say, the North Sea. Remember, in the Gulf of Mexico, you're seeing faster flow rates and then higher eventual decline rates. So the same fields will actually produce 20% greater value in this discounted way of thinking about it in today's money. And likewise at the top, if you try and compare the economics in the different fields, of course you run into the problem that the tax rates are just very, very different. They're pretty good in the Gulf of Mexico and pretty terrible in Norway and Russia. But if you just strip that out and you just compare the difference due to the production profile, it's about $2 a barrel in today's money for a discovery with an offshore production profile versus an onshore one, just because you get the oil out sooner under these production profiles. I have problems with the clicker here. Oh, there we go. So likewise, this is the kind of bold theological statement I'm going to make today. I think when Brazil discovered its pre-salt oil resources, the then president Luiz Inácio Lula da Silva said, "God is Brazilian," because he was blessed with such a phenomenal resource base offshore. And I have to say that having looked at all these different basins, we're kind of inclined to agree with him. This is an index of the let's see how many it was. It's 1,400 wells in the Campos Basin to date in the deep water, and about 3,000 in the deep water Gulf of Mexico. And what you see here is that the Campos Basin wells just ramp up to a higher number, about 15,000 barrels a day on average, and they decline slower. I should highlight this is not all wells. This is just the largest, i.e. the ones that produce over 10,000 barrels a day, what we call the monster wells, because they're so prolific. But again, just highlights the quality of the Brazilian resource. And nowhere is that more evident for us than when we look at the economics of the pre-salt using all of this reservoir data. So what you see here is the flow rates from fields in the Campos, and this is the best wells, their maximum production at these different fields in the Campos. So these are the ones that produce about 60% of all of Brazil's oil. It's just 6 fields, I think. And the early tests from the pre-salt wells, these vast accumulations below the thick evaporite sequences in Santos Basin, producing 30,000 barrels a day at peak. And this particular well at Lula has been in production since May 2009, so it's shown almost no decline, so really, really strong. And again, you can kind of dig into the geology of what's causing this. Normally you'd expect fields with such high flow rates to have very high pressure, and when you have very high pressure you tend to have compaction of the reservoir, right? So it decreases the porosity of the rocks in the ground because you have the pressure of all this water on top of it and all these rocks on top of it still. And nevertheless, in the Brazilian pre-salt, you're seeing these vuggy carbonates that are, I've seen the core photos from some of the operators here. You can fit your head in the pore spaces between these stromatolitic carbonates. It's kind of amazing. And that's despite the fact that it's this really high pressure field. So we're kind of big bulls on the Brazilian pre-salt as a result of all of this analysis. But I guess I'm kind of digressing from the core of decline rates and what you can do about it. So let's return to that. if we look across all of these basins, again, one of the things we find is that your simplest, most obvious strategy for stopping your fields from declining is just to punch more holes in the ground, right? So here's all the wells and all the different basins, and all the fields indexed by how many wells were completed at the field that year. So, the biggest decline rates happen if you don't complete any wells, if you just let the field decline, and then it shrinks. But if you drill just one or two or three wells, in some of these basins you can actually keep the field stable. I mean, in Brazil, in the North Sea, in the UK, and in the Gulf of Mexico, 3 wells on average means your field won't decline that year. And if the incremental oil you get out is more than the cost of the wells, then it's clearly a good thing to do. The other interesting thing to note is the reliability of this infill drilling really varies depending on the basin. So the Gulf of Mexico, pretty reliable effect of drilling more wells. But if you look at a country like Russia, it's all over the place. And I think that's because, to really move the needle in terms of drilling enough wells to stabilize your Russian field, you probably have to be, somewhere over there, off the chart. And that's what you see. I mean, 900 rigs currently drilling at full steam in Russia to keep the mature Siberian asset base flowing. These are the same point, just looking at the sensitivity of these decline rates to new wells. Gulf of Mexico seems to do best, Russia seems to do least well, and if you think about the best place to be, it's probably in the middle, because you don't want to be too reliant on drilling all the time, because then when you have a drilling moratorium, your fields decline from their peak of 1.7 million barrels a day to just under 1 million barrels a day in the space of a year and a half. And you don't want to be unable to do infill drilling, because then you have to have this kind of rising capital intensity. This is the compound annual growth rate of just different service spending rates or activity in Russia under the environment of the ROCs winning and them having to just escalate the amount of workovers, wells drilled, rigs in operation. I guess the blue bars here are what we think of as applications of technology that are a bit smarter than just drilling more. And that it's a bit concerning that's being outpaced by just the brute force methods of drilling more and working over more wells. So Russia, I think, for us is in a category of areas where we need to see new technologies implemented in order to really stem the declines, and I'll come on to that in a bit. There's a similar story in Norway. A lot of you will know this is just one of the highest cost places to operate, and today the economics of drilling new wells and continuing the EOR activity in this country really depends on what you're getting out of the ground from every new well that you drill. So if you're getting 10,000 barrels a day out of a new well, of course you want to go and drill it, right? Because that is easily going to cover the costs of going out and drilling the thing. All the more so if you can be smart about where you put it, and you can do it in a low cost way. But if you're getting something like 2,500 barrels a day out of each well, under the economics that we see from the companies we follow, you basically break even at a $90 oil price assumption. And that says to us that if you take a field today that's only getting 2,000 barrels a day, or 2,500 barrels a day or less in Norway, and you ask, what the outlook is to just continue plugging new holes in the ground here, for us, we think that's going to stop. And in fact, there are some fields in that category. I think I presented this slide at a previous talk I did a couple of months ago, and since that time, 2 of the fields that are in this lower category, i.e. the ones where new drilling is not adding value. 2 of these fields have been shut down by Statoil. So actually, I'm quite pleased that this metric. Sorry, it's a very numerical slide, but it's just showing, which fields does infill drilling still make sense, and where does it make least sense. And it's just kind of satisfying to be able to predict which fields are going to be turned off, rather than be surprised by the press release when suddenly they say this production is not going to be realised anymore. So we aren't really fans of just drilling more and more and more. We like to see companies drilling smarter. And one of the things that we find can really help is if you go through all of these basins where you can get data on water injection or gas injection wells, it really visibly slows the decline rate. So you see this in the Gulf of Mexico, in Norway, and in the UK. Fields that have water injection wells just decline slower overall, not just the year you drill the wells, but overall they decline slower than fields that don't have water injection in place. And so, this is clearly a positive that you can start finding ways to use EOR to increase the production from your fields, not just the year that you implement the solution, but forever, because that gives a much greater payback over time. And not surprisingly, the more water you inject, the more your field tends to produce, although you could argue that correlation is happening the other way around. But if you look at the individual annual data, you also bear out that injection actually boosts production. And you can take an example like Ekofisk, where this is the entire history of the field, going back to the 1970s. The green bars here are the number of production wells you've drilled, blue is the number of injection wells, and the black is the oil production that results. So look, at Ekofisk you got up to 350,000 barrels a day initially, with actually relatively few wells in this phase one of the development, and then you had this monumentally high decline rate, basically to 100,000 barrels a day within 6 years. And so they undertook this enormous program. Interestingly, the injector wells in this work over the entire field lasted almost a decade. The injection wells outnumber the production wells. So it's not just drilling more, it's changing the way the field is managed. And what we've seen since then is remarkable stability, and even that the field has recovered to its original peak. So that's kind of a success story. And another one that I would point to is Samatlaw in Russia. I hope you can see this, but on the x-axis here we've got the cumulative oil production from the field, and on the y it's the amount of production each year. The field ramps up slowly over time, and then it gets to its peak. And what you see in the early days of its decline is a pretty slow rate. And then in 1984 to 85, the Russians really tried to increase production. This is kind of in the ending days of the Soviet Union, and they just started water flooding the field really, really aggressively. And so what happened was the wells started turning to water, and you've got these enormous 9 to 13% decline rates in these individual years. And then in 1986, Gorbachev spent, I think, today's money, it's the equivalent of about $20 billion, drilling hundreds of wells, and just managed to keep the field stable. And then the next year they didn't spend that money, and it just declined at 10% again. And at that time it looked like this field, which was originally on track to produce 30 billion barrels under the original estimates, was only going to reach 20 billion because of the precipitous rate of the decline. And so the reason I think this is a success story and not a depressing slide like the first ones is that in, I think it was 2003, TNK came on and took over the management of the field, and in partnership with BP, just again completely changed the way it's managed. David's Smart Water is all over, and they're very rigorous about which wells to keep in production, which wells to take off, making sure that the place that they're injecting the water is optimal for the overall field, because the problem you've had in the Soviet days is that you're water flooding the field, and you're injecting water down one well, and you're just producing that water in the well right next door to it, and nobody wants that. In terms of the overall outlook for this field, it looks like EOR has added 5 billion barrels here, and for us trying to figure out which companies we want to have in portfolios and which companies we want to be telling people to buy, people who, when you can do this, it's really valuable. In fact, I think this is one of the understated corollaries of the Rosneft TNK deal. We worked out if Rosneft can just incorporate some of TNK's better reservoir management into their Western Siberian asset base, it's worth something like $1 to $2 billion a year for them, and that on top of the higher free cash flow, and looks like an interesting prospect. So what it means overall is, I think comparing these decline rates to assumptions that we've gone through with other kind of industry data forecasters, such as the IEA or the EIA or other organizations, the decline rates we've measured tend to be higher, and when we model it, we take the existing assets, we work out how they should decline, and we add in the new projects. We come out about 3.5 million barrels a day lower in terms of 2020 production than the industry kind of generally, and I think that's something that might not be in people's numbers, but for us it means declining spare capacity by the end of the decade, and so we expect kind of rising oil price, and this is linked to a lot of other factors, but one of the underpinning reasons why we have a kind of tighter oil market forecast by the end of the decade is just really getting into these decline rates. So for us, it's been tremendously useful for understanding the assets, the companies, and the overall oil supply demand picture. Hope it's been interesting for you. Thanks.
Thanks, Rob. Thanks
Sure.
very much. Any questions from anybody? Your Brazil study was actually the latest, wasn't it?
Yeah, that's right. That was Monday.
Are you going to do the Middle East next?
I'm not going to lie to you, David. I think if I try and get data off Iranian servers on their oil production, I may just disappear. And so I mean, this is how we've put together all of the decline rate analysis here, is just pulling information off the BOEM, the MPD, the DEC website, and the ANP. They don't actually give it to you in a very useful form, so it's quite a lot of like web scripting that we use to pull it out. But I don't want to be in the realms of trying to hack Middle Eastern government websites, because I think it's a very limited career.
Okay. Anybody else? Okay, Rob, thank you very much.
Cheers.
Thank you.